Hey, this is Rod Cleef, and you are listening to the Mailbox Money Show with Bronson Hill.
Welcome to the Mailbox Money Show. I am so excited to be here with you today with my friend Justin Krane. And today we're talking about how do you analyze risk in your portfolio? What should you invest in? What are the questions you should ask? Why it's important to feel like you actually have a plan for where you want to go. If you don't know where you want to go, any road will take you there, right? And that's where a lot of people I think get it wrong is they don't figure out, I want to replace my income and fire myself, right? I want to do this. Or, I'm looking to pay less taxes because I'm paying 40, 30, 40, 50% in taxes. So anyway, this is a great interview. I think you're really going to join it. Let's jump in and do it. All right, welcome to the Mailbox Money Show. I'm so excited to have my friend Justin Krane here with me. Justin, how you doing today?
What's up, BH?
BHBE, Bronson Equity. We're in an entrepreneurs group together. And so we were chatting the other day and we decided we got to do a podcast swap and get on each other's podcasts. And you've got a great show. What's the name of your show again?
Money, you got this.
Money, you got this. So, Justin, as I mentioned in his intro earlier, he is a certified financial planner. And I'd love for this episode to talk about the return on life. A question people also have is allocation of, how do I allocate? I have all this money. What do I do with it? How do I allocate? And that's the question that's very difficult to answer because it just depends. It depends on everybody's risk tolerance. So we're not giving any specific advice to anyone. But why don't you give a quick little background about yourself, what you've done, how you got to be a CFP, some of the work that you do. I know you do stuff that's traditional. You're also interested in outside of traditional investments, which is kind of unique for a lot of financial planners. So give us a little bit of your background.
Sure. I've made over 5,000 mistakes as a financial advisor. My GPA was a 3.4. I am not where I want to be financially. I've been in the business 30 years and I really have no idea what I'm talking about. Literally, I believe
I feel like this is confessional here. I'm like, yes,
yeah.
do 20
But
Hail
like I
Marys
believe in like total humility. Like I have zero edge. I have no idea what's going to happen. And everything that I'm going to talk about, someone could easily Google and find the answer to. I'm just going to give a little bit of my perspective. And the question is when you hear these things, are you doing them? Do you believe in them? Do you not? And what are you going to do with that? It's really about taking action and being intentional with your money.
Yeah, that's great. Well, I love it. I love the humility. I feel like money and finances has a way at times of just kicking your butt. Like like things will happen. And like, I've lost money. Almost every successful person I know has at some point lost money or had challenges. And if they haven't, they're probably inexperienced or not being honest. And so I think, what you shared is awesome. I love that. So you tell us a little bit about what you're working on, what you're doing. You do a lot with investments, retirement, tax planning, insurance, all this stuff. So you kind of see the whole picture for a lot of people. Most people on this show and people we work with are high net worth. One question that comes up is, how do I allocate? Like I've got, I'm starting to go in more in alternative assets. Not everybody wants to go, 50% or 100% alternative assets. I'm pretty high alternative assets, but how do you I guess, why is that a hard question when it comes to allocation and working with an individual?
Because there's never really a right answer. Like I'll answer your question with a question that I'm going to ask you. It's such a dumb question. How long is a rope?
As long as you make it, or as long as it is.
It's like, how do you answer that? You could be like twice the distance from the center to the end. Like you can get all cute like that, but it's like, how do you make that? So I think the most important thing is to get clear on what you want out of your life. That's really at the end of the day. And to make decisions that are going to get you closer to where you want to be. It's really about merging your money with your life and making those decisions. Because when you make decisions about where you want to be and what your values are, you're going to feel good about it. There's that quote by Yogi Berra was like, if you don't know where you're going, you might get there.
Yeah.
So it's like, you got to be clear on what you want. And there's a lot of financial psychology that comes into making decision, especially, with everything, but like actually it's across the board, both alternative and traditional.
Yeah, exactly. Another Yogi Berra quote was, when you come to the fork in the road, take it.
Yeah.
No, but it brings me back to that saying, Stephen Covey, he talks about, begin with the end in mind, or
Yes.
Simon Sinek, start with why. Like where do you want to go? If you don't know exactly where you want to go or what you want to experience in your life, you're never going to be able to get there. So that's why I think becoming a really clear goal. And so for a lot of people, it's like in my book, like I want to fire myself. I want to replace my working income or my expenses with passive income. Like that's a good goal. Okay, well, how would you do that? Well, you need cash flow investments. What are the ways to be able to do that? I was a registered investment advisor. I do affectionately call myself a recovering investment advisor. And there are things about Wall Street that I found there's a lot of misalignment of interest. There's some challenges. Some of these things are pretty complex, even for the people selling the investments. Sometimes it can be very complex, written by a bunch of lawyers. Why don't you give us a little bit, kind of the behind the curtain of some of the challenges investors find in working, or investing in Wall Street investments, and how that leads into maybe alternatives or looking outside, or kind of how you incorporate plans or strategies or ideas for people that are seeing some of these things within Wall Street and some of the interests.
So I think one of the biggest challenges that people have when they're dealing with their money is clarity. They don't have clarity on, like I said, what they want. And they also don't have clarity in the scope of how they could work with a financial advisor or what it is that they're actually investing in. So to go down the RIA space or financial advisor space, there's two ways that we could work as advisors. One is called the suitability way, where we can recommend suitable things to our clients. We don't legally have to put them first. We can get paid a commission or a fee from a third party or, whatever. That's the traditional way of working. That's, like a bank or a professional Wall Street firm. They're going to operate under suitability. And that's why so many people have had bad experiences, because sometimes financial advisors and just advisors in general, don't put their client interest first. So that's the suitability way. And I came from that, working at a big Wall Street firm. And then the fiduciary way is legally the client is the only one that could pay you. The fee is disclosed in the client agreement, and you legally have to put their interest first. There's so much drama and regulation about protecting the client, the investor. And as a fiduciary fee-only advisor, we have to have a compliance program, a policies and procedures program, where we actually have to create it and follow it. And the regulators come in and audit us. Yeah. So, it would be great if there were no conflict of interest and everyone just got real financial advice. That's the way it should be.
I found it's interesting you mentioned that suitability thing, because I remember when I did my Series 65 and I was an RIA at Registered Investment Advisor, they would talk about suitability. And I just thought, like, suitability is such a funny word. It's like nobody uses suitability and like, oh, I'm looking for a suitable spouse or suitable this or suitable investment. And again, it's hard in finance. I think one thing I've realized is very few people or anybody who's incentivized, I'm not unbiased, right? I have investments that we offer. We've raised 45 million. I want everybody to do our deals because I love our deals. I love what we're doing, but that's not unbiased information, right? I have things, and if somebody works with somebody else, that's great. But I have found sometimes that talking with other investors can be really valuable. That's where some of the meetups and some of those things. And I found like a finance, particularly traditional finance, a lot of people don't talk with their peers around their financial investments besides, oh, I invested in this stock or whatever. But when it comes to like how I allocate my resources, some of the most valuable things I've seen, I saw a guy that he put up his net worth of 40 million, and he showed how he went from a duplex to how over the last 25 years he was able to grow it was just super valuable. You just never see people do that. But why do you think that's the case? Why is it it's hard to get really good financial information, particularly because those that give it are incentivized to give it, or they have things, there's a misalignment of interest, and people that like, I guess it's maybe just a taboo. We don't like to talk about our own finances, right, with peers.
For sure. Yeah. Let's start from the beginning, which is we have these money stories in our head that we get from our parents. Yeah. And usually there's at least one parent that can influence a child to have a negative relationship with money. Like my dad didn't teach me anything about money. I knew that he was successful in his business, but he didn't tell me how to manage it. And my mom didn't know that much about it. So I had to learn it on my own rather than have someone teach it to me, which then goes into like, a lot of people don't like to talk about money. It's a private, confidential thing. And then on top of that, when you get into someone showing their money, especially for our industry, we can't be overly promissory with clients and be like, invest with me, you're going to make a killing of money and all that kind of stuff. The regulators don't want us to do that. And I don't even think it's right, because you don't want to overpromise and underdeliver and then set a relationship up that's not going to meet the client's expectations. So there's so much to unpack there about the psychology of money. But I mean, I believe in some very simple principles. The first one is diversification. We can talk about any of these. The first one is diversification. The second one is compounding of interest. The third one is there's no such thing as a free lunch. If you invest in something that's paying 28%, clearly there's more inherent risk than something paying 4%, whether it's market risk, liquidity, taxes, whatever it is. There's more risk in that. So there's no such thing as a free lunch. And then number four, I do believe in rebalancing, meaning you have a target allocation and whatever it is that you want to do. And whatever goes up is what you would sell and rebalance and buy more of what goes down, which is the exact opposite of what the public does. The public, when the stock market gets killed, they sell out, which is a great time to buy, because these things, whatever asset class you're talking about, they don't go down and stay down permanently. But people think like that. But they do come back. So, and I also believe in indexing. Like, I don't really believe in active management. I think it's very, very hard to beat an index. So I'm 100% all in on indexing. And I think no one knows anything. Literally. I really believe in indexing is a better way to go. Yes, it's okay to do some stock picking, and I have that with some clients, but I'm a believer in indexing overall. It's a great strategy with low fees and long-term good numbers. Again, this is not individual advice. Work with your own advisor, but I just gave you like 8 philosophies that I have. We can talk about any of them.
Yeah, well, I want to talk about a few of them. I think there's a lot there, and obviously you've had some time to really refine your process, which is great. So let's go back to the idea of return. So we have the risk-free rate, right? Which is like, okay, this is what I would get in a treasury, or this is what I would get in, or where inflation is. You can different ways you can determine what that is. So if something is a 20% return, is it always going to be greater risk than a 15% return?
I always know, but we have to define what risk is.
Please.
Risk is standard deviation, which is the variability around a mean. So for the listeners who are like, what the hell is that? I'm going to explain. Let's say you go to Chicago, and the average weather in Chicago in October is 60 degrees, and it can get as high as 80 and as low as 40. So the variability is 20 around that 60. Yes, 80 and 40. So 20 degrees variability. If you go to LA and the average weather is 65 and it can get as hot as 70 and as low as 60, I'm making this up, by the way. I'm just giving you the teachable moment here, is that the variability around that mean is 5 degrees. So LA is more of a conservative portfolio than Chicago, because Chicago varies by 20 degrees. So when you say if something's paying 20, is it always going to be more risky? That's hard. But generally, if something's paying 20, or there's quoted as 20, or historical returns are that, it's only because the variability of returns most of the time is way higher than the variability of return of that treasury.
Yeah, that makes sense. Yeah, the variability. Now, the question with that, and this is a great question about to really analyze risk, because I think for us, this is just a transparent thing. There's certain investments that are like U.S. treasuries, or you could say bonds, or high yield savings accounts, or money markets. They're considered to be very, very safe investments. Then you've got over here on the other end, you've got venture deals or private equity, or things that maybe seed capital, or things that maybe 10x or 100x potential, but likely it's going to go to zero. Like you've kind of you're okay with the fact it's high risk. But some of the stuff in between in alternative assets, and this is where we got pinched. We were assuming that multifamily deal, good operator, whatever, it's all pretty generally kind of on the safer side. But then when the debt situation happened, where all of a sudden rates go up, a ton, and then some of the valuations of these properties go down 30 or 40%, it created a lot of challenge in multifamily investments at the time. So now, of course, that's kind of come around. Now we're seeing great deals, and we're buying, we're taking advantage and things like that. But what do you find, I guess, in an asset like alternative assets, commercial real estate, where you don't necessarily have the data in the same way. Like you have historic data when you're looking at stocks and bonds and indexes, but you don't have it. It's like this is a kind of a blue space, or it's like, well, blue ocean. I don't really know exactly what's going to happen. How do you analyze risk in something like that?
Okay, so don't laugh.
I'm already laughing.
I have no idea. Literally, I have
Yeah.
no clue. If you can't timestamp an investment ever all the time, and I know that these deals get marked to market and there is some value there, but you have to somehow look at the variability. It's like people think, I actually read something this morning that people think this is not what has been the best investment, but people think this is a Gallup poll that what they think that real estate has been the best investment. I'm not saying that it has or it hasn't, but the people that have been interviewed have said real estate is, because you can't timestamp your house or an
Right.
investment property every day or every month. So the variability or that price you can't see, so you don't know. And if you don't know, and you can't value it, maybe it's not as volatile. What I think is the key thing. I mean, this is, and everybody knows this, and I know you know this, everybody listening, but this is how, if I were you, I would think about investing with risk. How much of a return do I need to make so that I can live my life?
Hmm. Yeah.
That's the key thing. I mean, the people who invested with Madoff are killing themselves, the ultra high net worth people. Did they really need to make 20% rates of return to do what they wanted? No, they could have made 4 and been fine. Now, obviously, it's good to try and, risk and grow and all of that. But at the end of the day, in order for you to have financial peace of mind, you have to know that you're going to be okay. And and if you don't know that you're going to be okay, then you have to model it out and look at scenarios and see what kind of rate of return you need to get
Yeah.
so that you can be okay.
Well, and it's the thing too. I think with investments, no matter what it is, I mean, we call traditional investments really stocks, bonds, and other financial vehicles. One thing that I like to share and talk about that, over the long run, we've seen generally a very strong growth in equities, particularly index funds and different things. But between and there's an example I like to bring up. People say, "Well, it couldn't happen now," but 1929. You had an 89% drop in the stock market, which is if let's say it's the Dow Jones is 40,000 ish. If it went to 4,000, right? It's just
Mm-hmm.
substantial over a period of 3 or 4 years, and then
Mm-hmm.
for it to recover, because it always recovers, always recovers. Well, it took 25 years for that to recover, and that's not including inflation. And so
Mm-hmm.
obviously, everybody. I mean, I'd love to know if you think that it hasn't happened in 100 years. So everybody thinks, oh, it's completely, it would never happen. There's, algorithms and the market shut down, different things. But I mean, is that something that you think of when you assess risk as well, when you think of things like index funds and just traditional stock and bond investing?
I definitely think of risk with the stock market in terms of standard deviation. I do. And that's why you need to invest in things that are not correlated with stocks or have a lower correlation with stocks.
Like what? Like what would you suggest is that?
Well, bonds are not as correlated to stocks as stocks are. Real estate are not. Commodities are not correlated. Gold is not. Um, uh, um, Oil and all those are not. However, if you look at Bitcoin for the last year or two, highly correlated to stocks. So
Yeah.
people think, oh, I'm diversified with that. So I'm gonna do Bitcoin. You could also invest in alternative assets, whatever that is. The correlation to that to the stock market is a lot less. However, we got to go back to 1929. There were 2 Securities Acts that were not there: the 1933 Security Act and the 1934 Security Act, which the government basically put in to protect investors a little bit more. But let's go to something that was just so much more recent. Let's talk about the Federal Reserve and let's talk about COVID in 2022.
Sure.
What Powell did, in my mind, was he was a hero. The
Yeah.
guy cut rates to zero. There was one weekend where if he didn't cut rates to zero, Boeing would have gone out of business. The same thing in 2008, where B of
Right.
A had to buy Merrill, and there was that whole thing. But the Federal Reserve, Powell in particular, I think that guy rocks. He is really, really good. He should have raised rates a little quicker with inflation. But the reason why the stock market went down by that much is because there wasn't regulation. And what he did in 2022 he did the right thing. So
Yeah.
I think what I'm basically trying to say for your listeners is the Federal Reserve, Powell, is very, very important to the stock market.
Right.
Very.
Right. No, it does provide stability. But at the end of the day, I think a thing that shocks a lot of people, maybe not a lot of people on the show, but in general, is that these are markets, right? If like, it's basically what somebody's willing to sell and what someone's willing to buy for. If there's not a
Yeah.
buyer, the price goes down.
Hmm.
And I think there was a time, I'm imagining, and of course I wasn't alive in the 1930s or the 40s, but there was probably a time where people were like, "Oh my gosh, why would you ever buy stocks?" Right? Because stocks, a lot of people just lost their shorts. But again, this was not the whole population. But there was a lot of pain there as well.
Hmm. Hmm.
Let me ask you this. I have a question. This is a little more macro picture. So, do you have any concern that I think we're increasing our federal deficit by about $1
Yeah.
trillion every 90 days,
Yeah.
and that we have the reserve currency, which there's benefits to that. There's also something called Triffin's dilemma, where it's like I was a senator in the 60s that said, could we discover that we have this incredible benefit by being the reserve currency, but the downside is it hollows out manufacturing and things like this. But is
Hmm.
there a point where we get to where right now there's really no good alternative, like the euro, the yuan, all these stuff. There's no really good alternative to put cash into. But is there a point where we just spend, inflation or something gets out of control, and then it almost like there's an alternative that has to be forced? And I mean, what do you think about kind of fiscal spending and kind of what's happened the last 20 years in particular?
Um, it's a little out of my wheelhouse. So I
Right.
just,
Sure.
it's
Yeah.
I'm more traditional in the planning side. But yes, the deficit has gone up. Yes, things are a little bit more, bigger, the Fed's balance sheet. I think that we have to bring it in. And when rates were at like 1 or 2%, I would have, for the Fed, I would have issued a gazillion, trillion, $1 billion worth of debt and refied and paid all the other stuff off lower and just
Yeah.
brought it all down. But
Yeah.
Powell, from what I've read, no, that's an extreme. He's doing some of that. He's bringing in the balance sheet and all of that. But in my opinion, is the world going to end and there's going to be a stock market crash because of the deficit? There's 30 million hedge fund managers that have said that, who have not kept pace with the S&P, who have kept people out of massive upside in the stock market. So
Right.
if you have a goal 10, 20, 30 years, you should be able to ride out the volatility of the market in a diversified portfolio, not just all in stocks. So I don't know. I don't know. And the thing is, can
Yeah.
someone afford not to invest in something with risk because they need the money in the future to grow,
Yeah.
whatever it is? You have to do something. But yeah, I mean, what's the alternative? What is going to happen? Are we going to just take all the money out of dollars and put it in? I don't know. I mean, like, what do you
Yeah.
think?
Well, that is like a good question. I mean, I think I do. I've gotten in the last 5 years into precious metals. Precious metals was, back in the 20s. You could go into a bank and put a $20 bill in there, and it said,
Yeah.
payable to the bearer in demand in gold. And so there was this anchor that we had, a kind of a 1 for 1, and then it got to be like a 30% or certain reserve. And now, basically, since 1974, I think it was, since Nixon went off the gold standard, we have no, like, all the currencies are basically pegged to the dollar, which has no, we
Yeah.
just create. So,
Yeah.
it's yet to be seen, but that's where I do like real assets. I like things that,
Sure.
particularly if you use debt for them and get into things that, but again, it's hard to say what's going to happen. I mean, to me, I don't think we're going back to a gold standard, but I think that having something that hedges inflation is good. Having them that's non-correlated as much is good. But
Absolutely.
well, let's talk for a minute. We're kind of getting short on time here, but give us, for people that want to connect with you, give us some of the services and what you offer and kind of how you work with high net worth individuals and entrepreneurs, and what are some of the things that you offer.
Sure. So I'm going to ask you this question. If you had like $80 billion, what would you do?
What would I do? I'd
Yeah.
probably start trying to figure out how to give it away.
Okay. Give me a name of a charity that you would give it to,
I'd
or
I'd probably
a
I'd probably
cause.
start one. I'd probably start one or find multiples. I mean, it's such a large amount of money. Yeah, I wouldn't be able to. I mean, a big cause I love is fighting human trafficking, and so I think
Yeah.
I would just have to create. I just to figure out, okay, if we're going to put this in, how do we do this?
Do you have a connection to that
I
cause?
do have some, but not 80. I mean, $80 billion. You wouldn't, like, you'd have to, like, I mean, there would be a lot of work I'd want to do below that to figure out. I mean, it's too much money to give a lot of small organizations.
Yeah, but what is your connection with human trafficking? Like,
Well, my sister started an organization that was fighting human trafficking. I had a connection there. I've heard some of the
yeah,
stories. I mean, it's 20 to 40 million people
yeah,
in the world. There's a story of a teenage girl that was rescued in Greece, and just when she was rescued, said, why didn't you come sooner? And
sure.
just someone me kind of broke and said, this is it, man. This is why I'm alive, is to
Yeah,
help fight this.
yeah. So, I mean, that's very deep and intense and touching. So, if I was working with a client, I would say, how can we use part of what you have to be more aligned in that space? So that's an
Yep.
example. Another question that I would ask you is, let's say you go to the doctor and he says, Bronson, you have 5 to 10 years to live, and you don't know when you're going to die. What would you do?
Man, I don't know. I don't know if I'd be living
These are
different than I'm
deep
living now.
questions.
These are deep. These are deep. Well, this is,
Yeah,
I mean, money, that's what it should draw. It should draw out what's
yeah,
important to you. I appreciate the questions. I mean, I think I'd continue to come back to kind of the things I'm doing now. What are my values? What are my goals? It's all about impact. Who am I
hmm
actually impacting? How am I impacting? Creating, memories, creating memory, travel, doing things with friends and family, trying to
yeah,
invest in people around as much as I can. I mean, if I'm living in alignment with my values, if I die today, like I died today, like it's like I see it as like
yeah,
I'm here. I did what I'm here to do, and I
hmm
believe in afterlife and spending life with God. That it's like it's more of a continuation rather than it's like
yeah,
it's totally done. So I think if someone's aligned with their values and they're thinking with the end in mind, even like, hey, if I die today or in 50 years, like I want to have lived a life that was a wise life.
yeah, yeah. I mean, thank you so much for sharing that. That's
Yeah,
really, really nice. So I would give you financial advice based on that, right? Based on
yeah.
the things that you want to do. We would structure your portfolio, we'd structure your cash flow, I would make recommendations, we would come up with a plan, we would bring in your family. All of that financial advice is based on what it is that you want to have happen.
Yeah. Yeah. Well, that's great. I just really appreciate that about you. I think it's great to have, someone in this space that is really starting with that for people. And so I just encourage folks for Justin, if you are interested in reaching out, he's someone who can kind of help you clarify what you're looking for. And that's stuff that we don't really do with client. We try to do, with our people that invest with our investments, and we want everybody to do our deals. But when it comes to like a plan and what you're doing, it can be worth paying a fee-based person to come in and create a plan for you. And I know that's what you guys do. So, Justin, how can people reach out to you, connect with you, follow you, any sort of resources, your show? Just give how people can get in
Sure.
touch.
Yeah, so I wrote a book called Money, You Got This. It's like a crazy, funny, little small short stories. It's like a Curb Your Enthusiasm and Seinfeld. It's a book about nothing. Like it's zero, but it's a funny book and there's no plot and you could drink a few beers or have a cocktail or a cup of coffee and read it. It's great. You can also find me on LinkedIn, just Justin Krane with a K. You can go to my website, Krane Financial Solutions with a K.com. I'm sure there'll be info in the show notes. And you can get me anywhere. I mean, LinkedIn's probably the easiest.
Awesome, brother. Well, really appreciate you being here today. Looking forward to seeing you at an upcoming event, and look forward to being on your show as well.
Thanks, man.
All right, that was a great interview with Justin. I really enjoyed talking through understanding risk, understanding, how do you allocate. I love that we talked about the stock market crash and that you should be in different types of assets as well. Truly, in my opinion, nothing is fully non correlated. They think that stocks, bonds, real estate, they're not, one goes down, the other goes up. It's not necessarily the case. We could see things go down together, and there sometimes are precedents for different things. But getting in different types of assets, hedging inflation, finding ways to grow, using debt to grow wealth, particularly through real estate and other assets to provide cash flow, is awesome. So hopefully you enjoy that. If you haven't joined our investment club, highly encourage you to check it out. We're seeing some really unique deals in the business space, particularly where we're seeing a lot more cash flow. That's the thing a lot of people are not finding in real estate deals is cash flow. So some of these deals have very strong cash flow, or even some of them have some tax benefits as well. So go to bronsonequity.com and click the join button. You can also check out the link below, and look forward to connecting with you. You'll set up a call with our team, and we'll get you connected to our deal. So thanks for taking the time to educate yourself. Look forward to seeing you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.